Okay, let's unpack this. Welcome to the deep dive. Today we're digging into Mahindra Holidays and Resorts India Limited, MHRIL, their recent performance and strategy.
Yeah, it's a really interesting one if you follow the travel sector or even just how big companies, adapt when things get tough.
Definitely. We're working off their official Q2 FY26 earnings call, the investor decks, that kind of thing.
And the mission, I think, is twofold. First, how on earth did MHRIL manage not just to survive, but actually post strong profits during a quarter with absolutely killer monsoons?
Right. That weather impact was huge.
Exactly. And second, they're making this big shift, talking about a capital-light future. What does that really mean for hitting their big target, 10,000 keys, so 10,000 rooms, by FY30?
Okay, let's hit the big headline first, the number that jumps out.
Go for it.
Consolidated profit after tax, the PAT figure, it just soared, up 47% year over year.
47%. And this is despite those heavy rains causing, what, an estimated 10,000 nights lost? Cancellations, disruptions?
10,000 nights. It's a massive hit. So yeah, the hook is really, how did they pull off that profit jump with that kind of challenge? And what's the deal with this capital light strategy for their future rooms?
It's kind of a stress test for their whole vacation ownership model, isn't it? Most tourism businesses really feel the pinch from weather, the economy.
Everything, yeah.
But MHRIL found a way to stay stable. We need to figure out how they got that bottom line growth when, parts of North India were practically underwater.
All right, let's dive into those Q2 numbers first, the standalone figures.
Okay. So standalone profit after tax, PA, was Rs 51.7 crore. That's up 10% on last year. Pretty solid.
And standalone EBITDA.
Also strong. Rs 140.5 crore, which is an 18% jump year on year. Healthy stuff.
But it's that consolidated number that really tells the story, right? Includes the subsidiaries.
That's the one. The 47% leap in consolidated PA, hitting Rs 16.9 crore, it signals the whole group's performing well.
And what about revenue from people actually staying at the resorts?
Resort revenue is decent too. Rs 84 crore, that's up 8% compared to the same time last year. So people are still going, still spending.
Okay, now let's layer in that weather context again.
Yeah.
Management was very clear. Q2 was difficult.
Oh, yeah. They emphasized the monsoon impact, unusually heavy, really disruptive, especially, like you said, Himachal, Uttarakhand, key areas for them.
This wasn't just inconvenient rain. This sounds like it really hit business operations.
It did. You look at the broader hotel industry occupancy for August 2025, it dropped from 61% last year down to 59% this year.
So a tangible impact.
Definitely. And MHRIL put a number on their direct loss from all the travel chaos and cancellations. That 10,000 nights figure, that's a huge logistical challenge.
And this is the bit that's hard to square. Despite losing those nights and actually having more rooms available this year.
Yeah, an expanded inventory base.
They still kept resort occupancy at 73.4%.
Incredible, isn't it? It suggests their members are just incredibly loyal or maybe locked in.
Well, that brings us to the so what, right?
Yeah.
Why their models seem so resilient.
Exactly. It's the vacation ownership model in action. Members have essentially prepaid for their holidays through the membership fees. So MHRL has this built-in buffer against, sudden shocks.
The revenue's already kind of secured.
Right. It's secured upfront. So their profit doesn't just collapse if you have a few bad months of weather. The main transaction, the membership sale, that's already happened. It really shows the stability compared to, say, a traditional hotel that relies purely on nightly bookings.
Okay, so they weathered the storm financially. Let's shift gears to their growth plans. That big 10,000 keys target by FY30, are they still on track?
They say they are. Management sounded pretty confident on the call, claiming they've got visibility on about 75% of that journey already in their pipeline.
75% visibility on a 2030 goal.
That's ambitious.
It is, especially when you consider where they are now. 5,742 keys across 118 resorts.
But the really interesting inventory move this quarter wasn't just adding rooms. It was taking some away. Yes, that caught my eye too. So they added 209 keys, a new place in Mahabaleshwar, expanded 4 others. Kandigat, Dindi, Patkat, Jaipur. Good stuff.
Hey.
But they also exited 261 keys across 5 different resorts. So net-net, they actually went down slightly in room count this quarter.
They called it a cleanup, I think.
Exactly. And that tells you something important. They're willing to trim the numbers, even take a short-term volume hit to protect the brand's quality.
So these were underperforming resorts.
Seems like it. Probably associate properties, maybe ones getting subpar feedback from members like, the voice of customer data they collect. They're treating quality improvement as an ongoing process, not a one-off.
That actually signals a lot of confidence, doesn't it? That they can easily replace that volume later with better quality options.
Precisely. They're basically saying, look, maintaining our standards is more critical right now than just hitting a raw room count number every single quarter.
And does this tie into the big strategic shift, the move to capital light?
Absolutely. It underpins it. Management confirmed that going forward, the majority of new rooms added won't be properties they build and own themselves. They'll mostly come from leased resorts.
That feels like a fundamental change in philosophy.
It is. They put a ratio on it. Future investment is planned to be roughly 30% owned properties versus 70% capital light models.
And capital light means?
Leased properties, or maybe built to suit where a developer builds it to their specs and they lease it back, or other kinds of inventory arrangements where they manage rooms in someone else's property.
The goal being speed and less cash drain.
Exactly. Get to that 10,000 key target faster without tying up vast amounts of capital in construction, frees up cash for, well, other things, maybe tech, maybe experiences.
Okay, but hold on. If 70% of your future growth is leased properties, how do you maintain that brand quality they just made a big deal about cleaning up? Don't you lose control if you don't own it?
That's the million-dollar question. That's the challenge they have to manage.
So what's their answer?
Their argument is that these aren't just any leases. Many are built to suit or have very specific operating agreements tied to them. They believe these structures give them enough control over the operations, the service standards, everything that impacts the member experience.
So it's a calculated risk, trading direct ownership for speed and flexibility.
I think that's a fair way to put it. They are still building some owned properties. They mentioned 2 new greenfield projects coming online next year near Gunpowder and Theog. So they're not abandoning ownership entirely. It anchors the portfolio.
And the impact of all this, adding, subtracting, focusing on quality, what does it mean for members trying to book?
Good point. They highlighted the member-to-room ratio. It's actually improving. It's dropped from 55 members per room last year down to 53 now.
So less competition for rooms.
In theory, yes. Better availability. For the average member listening, that's a direct, tangible benefit. It should be getting slightly easier to book the holiday you want when you want it. That's a quality boost right there.
Okay, so that covers the physical inventory. Let's talk about how they're filling those rooms, the membership strategy, and the tech behind it.
Right. This is where it gets interesting on the customer side. They're explicitly saying they're shifting focus. It's not just about signing up anyone anymore.
They use the phrase selective approach to member additions.
Yeah, and right, product market fit. They're aiming for a specific type of customer now.
And the proof is in the pudding, right? There was one metric that just blew up.
Oh, you mean the AUR, average unit realization.
That's the one. What is that exactly?
It's basically the average price or the value of a new membership they sell. And that number, it surged to Rs 9.3 lakhs.
9.3 lakhs. How much of an increase is that?
Get this, 85% higher than the same quarter last year. 85%.
Wow. Okay, that's seismic, as you said earlier. That's a massive jump in the average selling price.
It absolutely is. It confirms they're successfully moving the brand upmarket, premiumizing the customer base. They're not just chasing volume anymore, they're chasing value, maybe exclusivity.
Is that sustainable, though? An 85% price hike?
That's the key question. Was it a one-off surge, or have they genuinely repositioned the product? Management seems to think it's linked to the higher quality inventory and experiences they're offering now.
And there's evidence that existing members see the value, too, isn't there? The upgrades.
Exactly. Member upgrades hit Rs 56 crore in the quarter. That's up 24% just from the previous quarter.
So current members are willingly paying more to get into higher tiers or longer durations.
Seems so. That's a powerful sign of customer satisfaction and effective upselling. Your existing base believes in the value enough to reinvest.
And how are they finding these higher value new members? Less cold calling, more referrals.
Precisely. They're leaning heavily into channels with better ROI, moving away from some of the traditional, maybe more expensive sales tactics.
They mentioned referral and digital channels specifically.
Yes. Those two combine the high-frequency referral program, HFRP, and digital leads now account for 66% of their total member additions. That's up from 58% last year.
So 2/3 of new members are coming via referral or online.
And they specifically called out referral as the best channel, which makes sense, right?
Why is that? Lower cost.
Lowest cost of acquisition, highest conversion rate. Think about it. If your happy existing members are basically acting as your salespeople.
You spend less finding leads, and the leads are already warm.
Exactly. It's super efficient growth. And it suggests the member base is genuinely enthusiastic.
And they're using tech to make sure the sales process itself is consistent.
Yeah, they talked about fully rolling out DigiSales. It's a digital tool for their assisted selling teams.
What does it do?
Sounds like it standardizes the information, the pitch, ensures compliance. The goal being everyone delivers the same quality interaction, which should theoretically improve conversion rates across the board. 100% adoption, they said.
And AI is playing a role beyond just sales tools.
Oh, yeah. They mentioned an AI tool called Rio. Apparently, it predicts resort occupancy up to 60 days out based on booking trends.
So they can anticipate demand better.
Right. And dynamically manage their inventory. Maybe shift room availability between resorts, optimize pricing, basically squeeze more yield out of that 73.4% occupancy they're achieving.
All right.
They also said AI is crunching all that voice of customer feedback from surveys, reviews, calls, turning all that qualitative stuff into actual operational changes.
Okay, let's broaden out. How are they differentiating themselves in the long run? It's a crowded travel market.
Their big play seems to be shifting the narrative. They kept stressing, we're not just about the room, the focus is on experiences and memories.
Sounds a bit like marketing speak, but what does it mean practically?
Well, they're positioning themselves quite deliberately as the brand for family vacations. They feel that's a niche they can really own.
So things like kids clubs.
Exactly.
Yeah.
They mentioned the Happy Hub for kids, which lets parents, use the spa or do other activities. It's about curating that entire family experience, not just providing accommodation.
And presumably, that curated experience helps justify that higher price point, the AUR we talked about.
That seems to be the logic, yes. Sell the whole package. The guaranteed family fun, not just a hotel room.
What about their international footprint? They have that European operation, HCRO.
Right. Holiday Club Resorts OI. It's got about 33 timeshare locations, Finland, Sweden, Spain, including some spa resorts.
Is it a big part of the business?
Occupancy there is apparently very high, close to 90%, but in terms of total rooms, it's still relatively small, less than 15% of their total key count right now.
So are they planning a big international push? Does that fit with the capital light model?
Well, that's where the capital light strategy really applies internationally. The plan isn't to go out and build lots of Mahindra resorts overseas.
No.
Instead, they plan to grow internationally mainly through inventory arrangements or associate partnerships, again, avoiding big capital outlays.
So testing the waters.
Exactly. Using partnerships to gauge demand, especially as direct flights from India increase without taking huge financial risks building properties themselves. It's low-risk expansion, aligned with the overall strategy.
Okay. And that brings us to the final point, the tease, the hint about something bigger coming.
Yes. The management dropped some pretty strong hints. They're working on a new vision, a new strategy, something that goes beyond just vacation ownership.
Beyond timeshare.
Yeah.
To make the company significantly larger.
That was the implication, and they said an announcement could be coming very soon.
What could that mean?
Well, they explicitly said they're looking for ways to accelerate revenue growth beyond the usual sources, membership sales, and the annual subscription fees, the ASFs. They know that historically, that's often single-digit growth.
So they need a new engine.
They need something new to really kick things up a gear, a completely new business line, potentially.
Okay, let's try and wrap this up. What are the main takeaways for someone trying to understand MHRIL right now?
Well, first, they handled a really tough quarter exceptionally well. That vacation ownership model provided real stability against those external shocks, like the monsoons, allowing them to post impressive consolidated profits.
So model resilience, check. What else?
Strategically, there's a clear pivot. Number one, intense focus on quality, even if it means trimming room counts temporarily. They're cleaning house.
Right, the resort exits.
Number two, the big shift to 70% capital light for future expansion. Speed over ownership, basically.
Yeah.
But with controls to maintain quality.
And underpinning all that is technology.
Absolutely. Tech optimizing everything from sales, driving that record 85% jump in AUR, to predicting occupancy with AI, to analyzing customer feedback.
And the brand positioning is clearly shifting towards curated family experiences, not just rooms. Trying to own that family vacation space.
Which brings us back to that final intriguing tease about a new strategy.
The provocative thought to leave people with.
Yeah, Given everything they're doing, the focus on experiences, the hunt for non-membership revenue, the capital light approach, what could this new strategy be?
Is it just about finding ways to make more money off people who aren't members but might visit their resorts? Like
Yeah.
monetizing restaurants or activities better?
That's one possibility, leveraging the assets they have. Or is it something more radical? Are they planning a pivot into a totally adjacent business, maybe leveraging their real estate expertise or their large member base for something completely new?
Redefining what the MHRL brand even means.
Could be. That's the big unknown. And honestly, the most exciting thing to watch for in their next update, will it be evolution or revolution?
Definitely something to keep an eye on. A case study in how companies try to adapt and grow even when facing headwinds. Thanks for tuning in.